Welcome students. In the process of discussing about the or learning about the financial estimates and projections, now we are at the last leg of this discussion, and in this last part of discussion we will talk about the multi-year projections. And multi-year projections are the requirement of the new projects or new ventures. And when you go for a project selection, or maybe finally giving a shape that yes, we are going to make investment in this venture or this project. So multi-year projections are important because you need the funds from the external agencies. I told you many a times in the past, also in the previous classes also, that we need the funds from the external sources, and largely in case of the new ventures or new investment proposals, the investment comes from the external sources. So, and the external sources are largely the venture capitalists or angel investors or private equity providers. So, since they are going to provide you the risk capital, venture capital, so they want to make sure that how the project is going to do, and over the years, maybe after its inception, over the years, how the overall financial health of the venture would be, the firm would be, the organization would be, and how this firm will do over the years. So, multi-years projections is the important requirement. In the previous class, we talked about certain projections again. There we calculated ourselves that if you are given the information about the current year, that is the year n, and maybe some information about the n plus 1 year, then how to project the remaining information for the n plus 1 year. In that discussion, we were given the balance sheet for the current year and the income statement for the ensuing year, first year, that is the say next year. So, n plus 1 year, and from that information of the balance sheet of the n year, current year, and income statement for the n plus 1 year, we prepared the cash flow statement, simple cash flow statement, not under activities, projected cash flow statement for the n plus 1 year, and similarly the projected balance sheet for the n plus 1 year. So, that was only 1 year projection. So, I thought that it would be better that if we have an idea about the multi-year projections, and we learn about that if there are to be the projections of the financial estimates for the multiple years, and we have to prepare the projected financial statements or maybe the dummy financial statements or the say pro forma financial statements, then what are the important considerations to be borne in mind. And with that intention, we have come here with these multi-year projections. These are already done. We are not doing it here just for the sake of understanding. We are just trying to see here. I am going to show you that how these projections are worked out, what is the initial information required for going for projections, and how the multi-year projections can be done from that initial information given for the current period, or maybe the called as the construction period, and from that period, that investment, how to go about the subsequent years of the projections. So, first year, second year, third year, fourth year, like up to 10 years. So, practically you have to go up to 10 years of the projections. And if you show that in the 10 years, what is going to be the profitability position, the cash position, and the financial position of the firm, then it's going to be very helpful for the say venture capitalists to take a decision whether to make investment in this particular venture or not. So, as I discussed with you in the past, that important consideration is of the firm arriving at the break-even point. So, earlier the firm arriving at the break-even point, better it is, because after that, whatever the remaining projected period is, that will show us the profits. Initially, the profits may be less, but they'll keep on growing over a period of time. So, what is the state of the profits? Initially, number one, when we are reaching at the break-even point, after that, when we start earning the profits, so what is the trend of the profits? Is it depicting a straight line, or is depicting a maybe a rising line or a declining trend? What is the state of the profit? And if the profit is stable minimum, even the profit is stable also, if it is rising, then it's very good. But even if it is static, still they can consider that it's only a projected information, but in the real sense, if they work hard, so the projections from the straight line to it may present a rising trend also, but it should not be depicting in any case the declining trend. So, if it is giving us a rising trend, so what is the slope of that rising trend, and what is the overall profitability position of the firm? They want to know about that. Similarly, as we have discussed in the past also, that the profit has to be supplemented with the cash. So, it is not only sufficient for us to work out the profit, because profit is a notional figure, profit is only nominal, profit is not real. That is why under accounting process, when you categorize a different kind of accounts, so profit and loss account is called as a nominal account. There are three type of accounts in accounting: personal account, real account and nominal account. So, profit and loss account is categorized under nominal account, and in the nominal account we take all expenses and losses and incomes and gains. So, whatever the end result of that account out of that statement is, that is also nominal, right? That's it, that is also not real. So, when it is a nominal outcome, it means the profit worked out in the income statement is a nominal profit. So, how to compare that with the cash, because cash is real, profit is nominal. So, converting that nominal profit into cash, we need to prepare the cash flow statement, and after that we prepare the projected balance sheet for multiple years to know the financial position of the firm. So, here for example, you look at this information is given to us. This information is given to us for the 3 periods, right. This is the construction period, this is the first operating year, second operating year, and rupees million information is given to us. So, this information is about the proposed outlay and financing, right. How much means funds we are going to get from the different sources, and how much expenses we are going to incur, long term expenses means capital expenditure we are going to incur. So, this information is available with us kind of. That was the same information in the previous example also, when I told you that the balance sheet for the n year or maybe the current period, that was available with us. That was also in the same form. That was also a statement like this, where on the one side we were given the all sources of the funds, on the other side we were given the capital expenditure as well as the current expenditure, long term assets, fixed assets and the current assets. And from that statement, like this statement, that was also a statement, and from that statement for the n year, that is current period, and the given in n plus 1 years of the income statement, we projected the cash flow position for the next year, that is n plus 1 year, and the financial position by preparing the balance sheet. Now, we are adding one more year here. So, we have 3 periods here. One is a construction period, so simply you forget that, but the projections are for the 2 years, year 1 and year 2. After starting the operations, we have the projections for the 2 years, year 1 and year 2. So, in these projections, for example, the input information will come from this statement, right. This statement is going to provide us input information. So, you can divide it into 2 equal halves, right. You can divide this information into 2 equal halves. This lower part is going to tell you about the sources, right. These are the sources of the funds. And here these are the applications of the funds kind of. So, it is a kind of a balance sheet. So, these are the applications of the funds, and this is basically a balance sheet. So, we have raised the funds from these sources, and these sources are, for example, equity or investment coming from the entrepreneurs or say the promoters is 10 million rupees in the first this construction period. They have invested initially 10 million or maybe 1 crore you can call it as, and then in the next year also some additional investment was required, and that was 15 million Indian rupees. So, 10 plus 15 becomes the 25 million rupees of the total investment has to be made or to be provided by the promoters or by the entrepreneurs to the business, and remaining amount will come in the form of the long term and short term borrowings. So, long term borrowings are the term loans, and in the first year construction period the term loans are 15, and in the first year the term loan is again 15, and in the second operating year the term loan is 7.5. So, we are continuously borrowing for the long term investment requirement. So, this is a very positive and healthy indication also, because you are borrowing, you need to make investment into the long term assets or fixed assets, largely for the long term or fixed assets. And if you are making investment into the fixed, additional investment in the fixed assets, it means the manufacturing capacity of the firm is growing. And why are you increasing the manufacturing capacity of the firm? Because there is a demand in the market. So, we are increasing the long term investment or the fixed investment. So, initially it was 15 million, then additional 15 million in the first year, and 7.5 million in the second operating period. So, this way we are talking about this total investment. And then we have the short term borrowings from the banks or other financial institutions, which was partly in the year 1, operating year 1, and partly in the year 2. So, total of the 18 millions of the short term investment has been borrowed. So total investment has come in all the 3 years, in the construction period, in the first operating year, in the second operating year, and this all makes the sources of the funds for us. And these sources will be utilized for what purpose? These sources will be utilized, number one, for raising or having the fixed assets in the firm, which are total. If you see, 20 millions worth of the fixed assets we had in the this construction period, 20 years of the fixed assets we had in the first operating year, and 10 millions of the say fixed assets we are going to have in the second operating year. And current assets we are starting to build in the first operating year of the 20 million. It's other than cash. It may be inventory, it may be credit sales, it may be prepaid expenses, it may be advance deposits, like that, right? Accounts receivables. And for the addition next year, second operating year, it is 10 million. So this is the total sum of the fixed as well as the current assets. And some small amount of the 2 million we have spent, 20 lakhs we have spent on the preliminary and pre-operative expenses also to make the firm functional. So you see, this statement is helping us. The proposed outlay and financing is going to tell us about that how much means sources we are going to have the funds from. So that is called as the financing, and where these funds we are going to make use of, these are called as the outlays or maybe the investments. So both from the long term as well as the short term sources we are going to raise the funds, and these funds we are going to invest into the fixed as well as in the current assets. So this is a first initial statement giving us the initial information. So when you have to present it to the investors, you have to give it in this way, that the total outlay required in the project is this much, especially in the long term as well as in the short term assets. And sources of financing, we are proposing something like this, that 25 million we will be bringing, 2.5 crores we will be bringing in the project, and remaining about say you call it as 37.5 million will be borrowed from the market. So debt equity ratio would be a balanced ratio, and the investors would not mind it if you are investing say 25 millions from your pocket as an entrepreneur. So remaining amount, maybe 37.5, can be had from the market. So if the overall profitability and cash projections and financial position of the firm is going to depict a healthy picture, they won't mind giving you the funds. But if the profitability is poor, or if the cash position is poor and financial position is not very sound, is not going to be very sound, so they may maybe have some reservations, and we have to address to their requirements also, so that they happily are ready to make investment into this new venture. Now we talk about in the multi-year projections. There are some other input estimates also available with us. First is the sales information over the first and second year. How much sales we are going to make? That is 30 millions worth of rupees of sales we are going to make in the first operating year, and 60 millions of sales we are going to make in the second operating year. Cost of sales information is also here. So initially means in the first year, it's a very grim situation that your sales value is 30 and cost of sales excluding interest and depreciation is also 30. So 30 and 30 both are equal. After that, the additional expenses on account of the interest and on account of the depreciation, that's going to be extra, and that will be paid by the firm from its own reserves or from the own say resources. Whereas in the second operating year, the position is going to improve, I guess, because your sales are going to go double. Cost of sales is going to remain lesser by 20 million. Interest component and depreciation, though, going to increase, but I think because of the difference between the sales and cost of sales, we can easily meet these two expenses and finally end up with the profit, or will be at the state of the profit. So from this information, this first information of the capital outlays and financing, and second information about the cost and revenues, we are going to now have the multi-year projections. And in these multi-year projections, you can say the profit and loss account is very simple, right? This is the projected profit and loss statement of XYZ Enterprises, and it's very simple statement we are going to have. It's a vertical statement, very simple, no big adjustments, not complicated adjustments we are going to do here, simply to understand the projections process. So in this case, we are going to say that, as we saw in the previous statement, your sales is going to be 30 and 60, whereas cost of sales is 30 in the first operating year, whereas it is going to increase by 10 million to 40 in the second operating year. And depreciation and interest component. It was 6.8 million in the first operating year, which is going to increase in the second operating year. But because of the sufficient difference between the sales and cost of sales, so I think we are easily going to meet these expenses, depreciation and the interest component. That is a fixed cost, part of the fixed cost and the financial cost. These are the two costs. In the cost of sales, we include largely the variable cost, and fixed cost in the form of the depreciation we are going to now subtract from the difference between the sales and cost of sales. You call it as a contribution, and the financial cost also, that is interest. So, in this case, when you go for the multi-year projections or for the 2 years of the projections, we will easily find out here that in the first year, though the firm is going to make losses, but in the second year the firm is going to make profits, and the total loss of the profit after tax is in the parenthesis, it means it's a loss, 6.8 millions of the loss in the first year, which in the second year is going to maybe totally reversed, and in the second year we are going to happily pay the financial expenses also, depreciation cost also, and absorb the previous year's losses also, that is 6.8 millions of rupees. And after that we are going to have a PBT, profit of tax, profit before tax of the 4 million. After paying a tax of 2.4 million, we are finally ending up at a profit after tax of 1.6 million. So now the situation is very good, very healthy, and from the second year onwards we are maybe in the state of profit, we have started earning the profits. So this kind of the situations are very much liked by the investors, and they feel safe, they feel secured that if we are going to make investment into this kind of the ventures, then certainly the situation is going to be very good for them, and their funds are safe, and they are going to get the good return on their investment also. Then the next we talk about is the cash flow statement, simple cash flow statement under not any kind of operating, investing or financing activities. Just on the top we are putting sources, on the lower part we are putting the disposition or applications of the funds. Funds means a cash here, we call it as a cash because now these days we synonymize the funds with the cash or cash with this funds. So this is basically the cash. So in the construction period, we have all these sources of the cash with us and dispositions of the cash with us. So in the operating period, we are going to have the equity of 10 million, and then we are going to have the depreciation for the year. Increase depreciation for the year is going to be not in the say first year. In the construction period, no depreciation, but in the first operating year, there is a depreciation of 2 and 2.8 million. And your long-term loans are, secured loans are going to increase from 15 million in the construction period to 15 million in the first operating year and 7.5 in the second operating year. And bank borrowings are also going to be not in the construction period but in the first and the second year, 12 and 6. So total sources of the funds are going to be how much? In the construction period, we have the total sum of the 2.5 crores or 25 million of the total funds available with us, and largely they are coming from the long-term sources. 10 million we are going to provide as entrepreneur or as the promoters, and 15 million we are going to borrow from the market. So total investment of 25 millions in the construction period, which is going to increase to 42 million in the first operating year and going to go down to 33.5 million in the second operating year. And in this we have all short term as well as the long term in the first and second operating year. But as far as the construction period is concerned, only the funds are coming from long term sources. And now disposition when you talk about, so first we are using the funds for capital expenditure here, and this is for raising the fixed assets, land, plant, building and machinery 20, and 10. And current assets are also going to increase in the current asset 20 and 10. So it means your working capital is also going to increase. In the construction period, it was 0, but in the first operating year, you have more inventory, you have more credit sales, you have more advance deposits, prepaid expenses. But in the second year, we have controlled the situation. Our inventory has also come down. Credit sales have also come down, prepaid expenses also coming down, and advance deposits are also coming down, similarly with the other current assets. Our interest expense is increasing because we are borrowing more in the subsequent years. So from the 4.8 million in the first operating year to 6.4 million in the second operating year. And preliminary expenses are 2 million, which we saw it was in the beginning. So total, if you talk about total of the B, means the disposition or applications of the cash, is going to be how much? This is 22 million, 44.8 million, and this is 28.8 million is going to be the total disposition of the cash. And finally, when you talk about the opening balance in hand, so nothing in the construction period, but 3 millions are in the first operating year and 0.2 million in the second operating year we had in our hands, and net surplus we generated. So during construction period, the net surplus was generated something like that. We had a total source of 25, we had a total application of 22, so we generated a surplus of 3, and in the first operating year we had a negative deficit of 2.8 million, and that was made good in the second operating period, maybe the third year, second operating period and second operating year, which became 4.7 millions. And closing balance of the cash and bank balance therefore is 3 million in the construction period, 0.2 million in the first operating year, and 4.9 million in the second operating year. So now you can easily understand here that we had a state of loss in the first operating year. If you go to that profit and loss account, the previous slide, so you will find here we are in the state of loss in the first operating year, and loss was also significant, 6.8 million, right? Now, as far as the cash position is concerned, despite having a loss of the 6.8 million, we are in the state of sufficient amount of the cash is there, 0.2 millions of the cash is available with us. And that too maybe after having a deficit of maybe 2.8 in the first year, first operating year. So in the construction period, we had a sufficient amount of the cash, so it's a right strategy. We had kept the reserves of the cash, sufficient amount of the cash with us of the 3 million. Out of that, 2.8 million is absorbed because of the deficit in the first operating period, and closing cash balance is still positive, though it's very small amount, 0.2, very thin, 0.2 millions, but still we have something in our pocket and cash is there. Now, because of the profitability in the second operating year, the cash position has significantly gone up. So if you go to the profitability component here, profit after tax was 1.6 million, and if you see the cash position, so cash position is very comfortable here, and it is because of the total, you call it as the sources of the funds. So we have the funds from different sources, 33.5 million, and total applications were 28.8 million. So the net balance with us is going to be a surplus 4.7 million, and the closing cash balance here is 4.9 million. But the point of caution is that this 33.5 millions of the cash or the total inflow with us or the funds with us are largely not because of any other reason, but because of the borrowings. Our borrowings have increased, right? Our borrowings are increasing. Equity investment is just 25 million, but after that the funds are coming from external sources. We borrowed 15 million in the construction period, we borrowed another 15 million in the first operating year, and we borrowed 7.5 million in the second operating year. So this is the one important point. And for the short term purpose also, we have been borrowing. We borrowed 12 millions in the first operating year, and second year also we borrowed 6 million. So this is positive balance is not because of any high amount of the profit, and in the second year you cannot expect a high amount of the profit. In itself, it's very good that we are in the state of the profit in the second operating year onwards. We had a loss in the first operating year, but from the second operating years, we are in the state of profit and our cash position is good. But largely this 4.9 is not because of any profits or large amount of profits, but large amount of the borrowings. So we have to be very careful and disciplined that these borrowings have to be properly utilized and converted into the production and sales, and finally into the profits. So if we are able to convert this investment, owned investment as well as the borrowed investment into the profitable purposes, then certainly our profits are going to improve in the third, fourth, fifth, sixth and subsequent operating years. And our profits are also going to increase, sales are going to increase, cost of production is going to remain under control. And finally, as a result, as a difference between the sales and cost of sales, our profits are going to increase. And if our profits increase, and large part of the profit is if it is on the cash terms, then certainly the cash position will also improve, and this 4.9 million may become 10.9 million and so on. So we have to be very careful that whatever that investment has been borrowed from different sources here, we have to properly utilize it, and we have to convert that into the production and sales, and finally into the profitability. And last thing we are going to talk about quickly is about the multi-year projections, and that is the projected balance sheet for 2 years, operating year 1 and operating year 2, and we are given information about the construction period also. So in this process, you have this balance sheet. We are having a balance sheet in the T format, right, dividing it into 2 equal halves. So in this case, we talk about, we have on the left hand side the liabilities and equity, and on the right hand side we have the assets. So we can easily have that information from the previous statements. Equity, we all understand, is that total equity in the second year is 25 million, which has become in the first year even. So we had initially in the first year construction period, we had invested 10 million, and in the first operating year we invested 15 more as an entrepreneur. So total closing balance of the equity became 25 million. After that, no equity is invested in the subsequent years. So at the end of the second year also, the equity balance is same as it was in the first operating year. So this is 25 million total invested by the entrepreneurs. It means 2.5 crores. And other equity is that by way of this profit transferred from the income statement in the second operating year to the balance sheet. So entrepreneurs have not pocketed any part of the profit. They have reinvested the whole amount of the cash back into the business. So the profit was, we have seen, profit after tax was 1.6 million, which is the whole amount is added back here, transferred here, and finally the equity has become 26.6 million. That is initially 25 million invested by the entrepreneurs, 1.6 million of the profit, retained earnings generated by the project. After that, we had the borrowings, total borrowings over the 3 periods, construction period, first year and second year. So in the first year, as we have seen, the borrowings, term loan were 15, and again 15 in the first operating year, so total amount became 30, and in the second operating year we borrowed 7.5 million, so the closing balance of term loan became 37.5, and short term borrowings were also there. So in the construction period, no short term borrowing was there, but in the first operating year the borrowing of the 12 million was there. 6 million we borrowed in the second operating year, so total amount became 18 million of the bank borrowings, short term loans. So this way, if you total it up, so this closing balance means the total of all your sources is given, 25 in the construction period, total of all the sources, liabilities and equity, 67 in the first operating year and 82.1 in the second operating year. And in case of the assets, so same amount can be corresponded in the asset side of the balance sheet also, where we had all fixed assets. Construction period, we had the fixed assets of 20 million, and after, say, adjusting for increase in the assets and subtracting for the depreciation, closing balance of the assets was left with 38 million in the second year, first operating year, and second operating year it became 45.2 million. So this balance has come to us from 20 to 38, right, and from 38 to 45.2 after, say, adding the increase in the fixed assets in the second year as compared to the previous year, minus depreciation, which we have to charge the depreciation also. So finally, this is the total amount of the fixed assets. For example, if you see here, the total investment in the fixed assets was, when you talk about capital expenditure, so it is 20 in the construction period and 20 of the investment in the fixed assets in the operating year. So total became how much? 40, and 2 is the depreciation, right? If you see the profit and loss account, so 2 million was the depreciation. So that way, the finally closing balance is not 40, but 20 plus 20 minus 2 is 38. And similarly, same process will be followed for this. So it is 45.2 million is the closing balance of the fixed assets. Then we have the current assets, cash we have already. So you have to take these figures from the cash flow statement, right? So if you see the closing balance of the cash flow statement, or the closing balance of the cash in the cash flow statement, so it is 3 million. You can refer back, 0.2 million in the first operating year and 4.9 million in the second operating year. Other expenses are also given to us, and we have then other miscellaneous expenditures which are given to us maybe in the different forms. So you can say here these expenses are given to us, and total you can say that is the total amount which we are going to make use of. So current assets and the total preliminary expenses are also going to be there. Other investments are also going to be there. So total investment when you talk about is others. So we have the fixed assets, we have the current assets, the cash here, and other current assets are going to be 20 and 30, which is taken directly from the first statement. And miscellaneous expenditure is again 20 and 30 more. So the total amount of this becomes as given to us is after this, these totals are here. And for having these totals, you have to have the preliminary expenses which were there in the construction period 2, in the first operating year also 2, and then it is also 2, right? And there was a loss in the first year. So that as we add the profit in the equity or maybe the liability side of the balance sheet, same way we capitalize losses, and those losses have to be shown in the asset side of the balance sheet. So reverse means, for the simple understanding, you can say it's a reverse entry, means profit will be added into the equity, so it will increase the equity, and the losses will be shown on the asset side of the balance sheet, and over a period of time these losses will be written off. So as the preliminary expenses we are writing here, they are expenses but we are treating them as an asset, and similarly the loss is also a loss but we are treating as an asset. So these are basically called as the factitious assets, which are initially capitalized, and over a period of time from the profit of the subsequent years, these losses and expenses are written off and finally removed from the balance sheet. So this total amount of the say expenditure we have done on account of the fixed assets, current assets, we have some amount of the cash also, we have the other current assets also. For example, if you go back to the other current assets, so we have the current assets here, something like this 20 and 10 of the current assets are here. So we are showing these current assets, 20 and 10 of the current assets we are showing here, and we have the total cash position also. So 20 and 10 means initially it was 20, 10 is added, so it became 30. And similarly, we have the miscellaneous expenditure also. So in this total amount, whatever the total say information is available with us, we are going to add it up, and finally we are going to make it as the final balance sheet for the multi-years, final balance sheet of the multi-years. And when we go for the multi-years projections or balance sheet of the multi-years, you can find out that our balance sheet is going to be is going to present us a balanced picture. And finally your this total is going to be 25, like this. This is the liabilities of 25, so this is also 25. We have the first operating years of the liability 67, so assets also 67, and here we have this of the 82.1, so this is also 82.1. So this way the total balance sheet we are going to tally, and this is the projected balance sheet for construction period and the two projected years, year 1 and year 2. And this way for the multiple years, you keep on preparing the projected financial statements. You have to go up to 10 years minimum, and if you are able to present your profit and loss position, cash flow position and financial position for the subsequent 10 years, in that case it's going to be a convincing, call it as a state, to the investors, and they can easily find out that if they make investment into this venture, what is going to be the fate of their investment, and whether it's going to end up with the say good returns on that investment or loss of that investment. And this all will depend upon the overall say production capacity of the firm, sales capacity of the firm, and profitability, cash position and the financial position of the firm. So these are the three projected financial statements for the multiple years, and you can keep on preparing for the subsequent years also, maybe after learning from the different resources. So for this financial estimates and projections, we will stop here. This was the last part of discussion, and the next part of discussion we will start in the next class. Till then, thank you very much.